CF benchmarks.
What you're about to hear is a recording of a CF Benchmarks X Space captured live.
Everything on this show is for informational and educational purposes only. It is not investment advice, and nothing we discuss is a recommendation to buy, sell, or hold any asset. The views are our own and do not represent CF Benchmarks, Kraken, or any affiliated firm. Any price targets, valuations, or models we mention are illustrative and not forecasts. The participants and their firms may hold positions in the assets discussed. Digital assets are volatile and you can lose your entire investment. And some products we reference may not be available in your region. Always do your own research and consult a qualified financial advisor before making any decision.
Morning. Welcome back to another CFB Talks Digital Assets Live. My name is Gabe Selby. I'm the head of research at CF Benchmarks. We are the leading index provider, and I'll be your host today. With me, as always, I've got Mark Pilipczuk, a research analyst at CF Benchmarks, Tomas Perfumo, the chief economist for Kraken. We do not have a featured guest this week, which gives us a lot of room to kind of just stay deep into the weeds of the markets, and also, maybe ask any or answer any questions that the audience may have live, so we can try that out. We've got a lot to cover. We just had a series of inflation prints, which is giving us more of a clearer read on the economy and perhaps where the Fed path may be. So we're going to start with that first. We're also going to jump into the September path for clarity and what that means. What are the chances of clarity making it through before the midterms, now that we've seen the Senate actually formally put it up for cloture in September. And we're also going to dive into some of the fundamentals on DeFi tokens. So there's a lot to kind of go over, and I think it's going to be a pretty great show. But before we kind of kick things off, I'm looking at the markets right now. I see Bitcoin hovering around the 63,000 handle still, so really in that consolidation territory. Guys, I'm sure you've followed the stretch perp, or I'm sorry, the preferred pricing. It's now getting closer to par. I wanted to kind of get everyone's take here on that. Are we getting back towards parity? And what's your opinion? Let's assume that we get back to 100 on stretch. Does that unlock a wave of sell orders for people that maybe want to get out of it now that they've kind of recouped their cost basis?
I guess I'll jump in. I think my personal opinion is that I think that preferred equities are actually more sensitive to Bitcoin prices than people give it credit for. So this is like charts that I produced in the past on X, showcasing some of the correlation between the sensitivity of the price of the preferred, or rather the effective yield of stretch as on the versus the same duration Treasury security, so basically the credit spread for stretch, relative to Bitcoin price. And so there was a big correlation, R squared, between the two of them over the last 2-3 months. And I think their moves to recollateralize the balance sheet and provide that like near-term certainty that we're not going to have some kind of liquidity spiral took us out of that territory where I actually thought that, just based on the regression analysis, that the stretch preferred was basically being underpriced, that the effective yield was way higher than it should have been, or what the regression would have you believe, and that we've kind of leveled off. But the thing that I think works against bringing stretch back to par is twofold. One, I think, again, just the Bitcoin price level, which dictates what effective yield people require from stretch. And then two, management has stated in their financial reporting that they do not intend to recommend a dividend increase or coupon rate increase above the 12% that they're at right now. And so it creates a situation where the market doesn't really have like upside catalyst to look forward to other than buying Bitcoin. And I think it kind of creates this weird competition where, if you think that stretch to get to 100 needs Bitcoin to rise, well, maybe you should just buy Bitcoin. So I actually think stretch is kind of just reflecting these higher interest rate expectations in the market more broadly, as well as the depressed Bitcoin price level that we're at today, and management's guidance that they do not intend to raise the dividend any further, and so it's priced at a discount as a result. I think at this point, if anyone was waiting for an opportunity to sell, it's already here. So I kind of feel it as like a balanced market rather than one where people are trying to squeeze the last couple bucks before they jump ship.
Mark, what about you?
Yeah, I'm kind of in the same boat on that. Like, if you were going to sell out, you probably would have done it. I'm just looking at the levels it's at. Before all the liquidity concerns back in April, it was sitting at 97, 98. We're basically there. So whether you're long there and you kind of got stuck in the trade and want to get out, you've probably done so. And yeah, if you were buying it at the 70s, trying to take advantage of the dislocation, I mean, you probably got out even well before this, probably after the announcement that they were raising more capital. And yeah, I mean, they're well capitalized now. They've they've increased that USD reserve several times. And the thing that I would almost look for is if this gets back to 100, I would probably expect to see MicroStrategy maybe even take the opportunity to raise some capital again via that stretch vehicle, because they have the dividend coverage, they have the USD reserve. You could probably see them hitting the market here soon and trying to take advantage of the lower Bitcoin price.
Yeah, it's going to be interesting to follow. I did watch the interview that Michael Saylor did recently with Stephen Bartlett, the Diary of a CEO podcast. I thought that was really a good conversation where he goes into kind of like the backstory of Stretch, and he talks a lot about how he came up with the idea using ChatGPT, and then it goes on to talk about how everyone should be using ChatGPT to come up with novel ways to do things, and in his case, he unlocked, I think, he said around $15 billion of capital with the Stretch idea. And so far, I feel like it's definitely had some bumpy parts to the ride. But the thing is that it's definitely you can't argue it hasn't revolutionized the way the preferreds market's kind of being structured with digital collateral like Bitcoin. So this is pretty neat to see. Yeah, I think TBD. Let's see what happens. I think we're going to get to. I am confident that we're probably going to get to 100 relatively soon, given the runway that that MicroStrategy's established. And let's just see, I guess, what the holders do if if people start to cut out. If you've assumed somebody has a cost basis of 100, if they want to get off the roller coaster, if new people even come in, like Mark was saying, you could see more issuance come out. So we failed to not talk about MicroStrategy for one webinar. I was hoping that we could get there with this episode, but I think we've already kind of failed at that. So I don't know if there's anything else we want to talk about with MicroStrategy.
Not MicroStrategy specific, but just in the broader DAT space. I've also been watching just Bitmine and how they've been raising and issuing and buying ETH. And one thing to kind of flag there is there's an Ethereum improvement proposal out right now that would change the way that the ETH staking yields work. It would lower the yields based on the percentage of the network that's actually staking. So you could actually start to see Bitmine, their cash flow, start to drop off as a result. So
why do you think they're wanting to propose that?
It's to reduce the issuance, to reduce the supply inflation on Ethereum, to try to address some of the. Yeah, I mean, we've all seen the performance over the last year. It's just been pretty inflationary with the drop off in fees. So they're trying to reach that equilibrium a little bit faster in terms of where issuance equals the burn rate to try to get to a long run supply balance.
Now, if we see that actually get approved and you see a drop in the staking rate, you see outflows in the DAT's holdings, I would assume that would actually make the performance of ETH relatively worse in the short term because you'd have more supply hitting the market, right?
Yeah, you'd see that, and also it would change the way that so with Bitmine's preferred shares, the advantage they have over MicroStrategy is the underlying asset has a cash flow component. So if they were using that to either to fund new investments or to pay dividends or anything like that on those preferreds, you'd kind of see a little bit less of an ability to pay. It changed the return profile of that specific vehicle, right? Now that you have a lower yield, and that was kind of the whole appeal to using ETH over Bitcoin.
Yeah.
I'll also add that the Bitmine preferreds are a much smaller percentage of the overall capitalization of the company. And another really big important distinction between what MicroStrategy's done and what BitMine's done is that the BitMine prefers are redeemable. I believe it's a 3-year term, and so the preferreds at MicroStrategy being a perpetual non-redeemable security, which is quite different. And so
Yeah.
I think that gives a lot more flexibility to BitMine relative to MicroStrategy's design. But yeah, I agree. I think for people that might not remember, there's a website that used to be kind of like the center of the Ethereum narrative, which was ultrasound.money, back before the merge and the burn was implemented. And what everyone was obsessed on with back then was this like declining rate of the circulating supply in ETH. And what's interesting is that over the last 4 years since the merge, the annual circulating supply inflation on ETH is only been 0.3%, which is actually lower than Bitcoin. It's substantially lower than Bitcoin. And so it is interesting to see this EIP come up. I think people are really kind of like symbolically trying to target that negative circulating supply growth rate to bring back that kind of money narrative to Ethereum that hasn't existed in quite a while.
Oh, that was a good shout there, Tomas. I remember that website and pulling some charts from it, getting the inflation story from ETH. So little nostalgia there. So speaking of inflation, we've got
nostalgia
inflation
for the $4,000 price level, or
it was nostalgia.
Yeah.
It was takes me back to a different time. So this kind of is a good bridge over to the next topic, which is inflation. And we've had a few prints that have hit our screens here. One this morning, one yesterday. So let's start with yesterday first. CPI for July came in right on the mark with consensus. And for equities, it was good news. For Bitcoin, it didn't seem to really move the needle. And actually, I think we saw some relative weakness come out of that print. What does that mean for the both of you? Maybe Mark, do you want to take this one first? Then we'll get the chief economist on the to wrap it up, because I want to know, does this kind of settle anything in your opinion, Mark? Like, does this settle us for a pause in the near term, or does this not basically just keep the door open?
Yeah, I think it's actually a pretty nice setup for a pause. So like the thing that I'll pay the most attention to is within the core CPI component, core goods versus core services. And if I look year on year, core services is contributing a total of about 0.15% to the headline. At its peak in September of 2025, it was adding close to 0.3% to the headline number. So we've actually seen that kind of almost cut in half over the last, call it 9 months. And if we like look all the way back to 2024, that core goods component was actually negative to the headline, and most of it was coming out of services, specifically shelter inflation. Since then, we've seen shelter inflation cool a good bit, adding about 1% to the headline, down from close to 2% to the headline. So we've really kind of, if you'd strip out the food and energy, which are the volatile components, we're on track. Core CPI year on year is down below 2.5% right now. So it's, you're not out of the woods if you're looking for that 2% target. I know the Fed looks at core metrics more than the headline, but that doesn't tell me that you should be hiking into that environment if it's all coming from stuff like food and energy.
Tomas, what's your read on the latest CPI report?
Yeah, so I'm actually gonna pull up some data from the CME Fed Watch, because this is the key message from my perspective. A month ago, the odds of a rate hold for the September meeting in about a month and a week, the odds for a rate hold a month ago were priced at 25%. 50% odds that we would get one rate hike for 25 basis points, and then there was a 24% chance we would get a 50 basis point rate hike in September. As of today, the odds are 66% that we hold versus 25% a month ago, and 34% that we get one rate hike of 25 basis points. 0% chance that we get 50 basis point rate. In my opinion, this is what's really driving the very near term trading range for Bitcoin is the shift in the probability or the outlook of the monetary policy trajectory, where we've seen Bitcoin price show weakness when the odds of a rate hike have been increasing, like they were a month ago into early August, and we've seen that with weaker job, like a Goldilocks weak job report, but also some of these call it in line to slightly cooler prints. That's changing for the benefit of the rate hold thesis. It's causing Bitcoin to trade pretty well. Yesterday, I think the inline print, to your point, we saw Bitcoin trade off a tiny bit, not too much. My gut says that, I think people were hoping that we would see a cooler print versus consensus expectations. Today, we had some aspects that were slightly cooler, which I think is beneficial because, between the CPI and PPI, a lot of those data points go into feeding the PCE index, which is the one that everyone refers to as far as sort of the benchmark that the Fed has indicated that they look at very closely. And so we now have line of sight that the PCE should be under control, let's call it. In which case, I think the thesis for rate hold has gotten much stronger, and I think it does help kind of levitate Bitcoin price. So that's sort of how I'm reading the market. Is yesterday inline prints, you might have a flat to down slightly day on the hope that it was going to be better, and then today's slightly cooler print I think brought some relief in the market. And you're seeing a little bit of a swing up. Of course, equities are also setting new highs, so that helps.
That's great. I'm particularly interested in this kind of downside, upside, inline surprise prints that we've seen and how it's been impacting Bitcoin. And you can compare that to things like the S&P 500 or to gold. And we were doing some research earlier this week. And when you compare CPI reactions across Bitcoin, equities, and gold, and you get a downside surprise print. So if the consensus is saying X and we deliver Y, which is below X, that's a downside surprise. Bitcoin averaged 3.25% on the day versus 2.84% for the S&P 500 or 2.13% for gold. So Bitcoin's actually had like more of a pop, right, when you get these downside surprise prints. So it's been definitely trading that rate path, like what you were saying, Tomas, very closely. And I think, with the inline print, like what we saw yesterday, it certainly doesn't warrant the relative outperformance that you've seen on downside prints. So in this case, it's kind of stayed in line with what we've seen historically. We analyzed over, I think, a year's worth of CPI prints, so 12 months or 12 data points. And that kind of tells you, I guess, where you can kind of position the portfolio if you want to stick your neck out and say, we're going to probably see a downside surprise. But the consensus has been pretty good, spot on, you could say, for July. I think where the consensus might still be off is on the hold. And it's certainly drifted up higher, like you highlighted there, Tomas, with the drift in probabilities. But if you look at the CME Fed pricing tool, if you compare that to what you can see in the betting markets, I think there's still upside, in the 60% range for a hold, which would be coming September. So just a little over a month away to get some decent upside, if that's your view. Now that trade has obviously played out in our favor. We called for a hold in our Q3 market outlook, and so far we've been right. Those odds have drifted up from I think what you said, Tomas, was the low 20s now to 60.
Yep, that's right.
So that's been a really strong performing trade there. And of course, we still have a lot more of the year left, and still have a lot of uncertainty left with what's going on in the Middle East. And that kind of brings me to my second question, which is we still have this oil timing problem. We've seen Brent reach close to $90 right before the CPI was released. So we've seen 2 advanced sessions on Brent. We know that that's going to be rippling through here in the August data. Gasoline prices likely to be impacted. How do we kind of square this timing impact, which we've actually been dealing with on and off throughout this geopolitical conflict?
I have a hard time like crafting a solid narrative around it because the facts just keep changing and the reporting is also very difficult when you have like constant contradictory statements coming from the U.S. and the West versus Iran on the state of negotiations and whatnot. I personally think that one take it like a very politically motivated take on this is that we're entering election season soon. The cost of living continues to be perhaps like one of the most important, if not the most important factor that people are thinking about in this election cycle. And it's pretty clear to me anyway that the administration is very cognizant of these kind of like price levels around crude oil and the impact downstream on gasoline and inflation rates and how that's playing into the broader narrative of is all this effort in the Middle East worth it, given the cost inflation we're seeing here in the U.S. And so like all of these things, in my opinion, play in favor of call it like a de-escalatory strategy. And it seems to be the case, at least my read of it, that the Trump administration is going back to, I believe it was probably the May posture, which was this, we're going to just focus on sanctions and blockade as and economic damage as our primary tool for pressuring negotiations or leverage in our favor. And I think the question comes back to, on those indicators, are we seeing success? And I think the answer is probably yes. Like if you look at the FX rates, I think the Iranian real is down something on the order of like 50, 90% year to date. Inflation is sky high there. Of course, like oil being a huge part of their economy is completely shuttered at this point. They're facing a lot of shortages. And so I think the question really becomes one more of like a political urgency situation within their country. I think that as long as you don't have kind of escalatory rhetoric going back to like kinetic threats, then oil has a reason to kind of hover where it is today. And yeah, I think that's kind of like dictating whether we see rate hikes or rate holds in the near future is really just driven by do we snap back into the 100s off the back of kinetic war that kind of lingers on, or are we just going to be this kind of holding pattern? In which case, I think it is more favorable that oil prices might stay or fall from here on out. But that's a very binary question. It's hard for me to tell you like with high certainty that it will play one way or the other.
No, I like that. Mark, what about you? Do you think this dynamic of getting into the midterms and all the political consequences of higher energy and cost of living, is this going to put like a Trump put into the equation?
I think it might, but like the thing is, when you have the war going on, there's not just two parties. There's multiple parties in the Middle East that are involved here. So it's hard to say how much a Trump put can really do, because how much can he really influence, right? Or can he influence the actions of the other countries involved? So it's more of a it's really hard to tell because of that dynamic going on. When you're anything's possible when you're in a war. It introduces a whole host of unknown unknowns, and I mean there could be any reason for escalation or de-escalation on either side. So as far as what the Fed, and it puts the Fed in a tough spot, because you can kind of look through this, because it can only go on for so long, right? Before the somebody runs out of money, or before the negative impacts in the oil market start to ripple through to our economy as well. So who knows? But yeah, if I'm the Fed, I'm going to try to look through this as long as possible, because a year from now, those CPI numbers will start to come down regardless of what happens to the oil price, just because we're looking at a year on year.
I'll add really quickly. I think the thing that, from a U.S. perspective, it's quite hard to untangle here is that at these, elevated prices of crude oil, it's a manageable issue for the U.S., particularly given our natural resource positioning. But when you think about more globally, whether it's China, Japan, Europe, certainly, the the impact of crude oil prices where they are now, especially Brent with the premium, but also the distillate products, it's a much sharper impact to that. So the question, I think, as it relates to the US is if we were to get a prolonged kind of impact or prolonged kind of a war outcome where the crude oil prices linger where they are even today, you could still threaten quite considerably global growth, in which case that does have some level of contagion effect back to the US. And so that's one that I think is perhaps a little bit underpriced, is just how fortunate we are to be a little bit more shielded from those impacts.
That's a good point. One thing that I've kind of tried to map out in my mind is, let's just assume that the Fed refuses to look through this energy shock. Let's just assume that this is, we're on track for the rate hiking cycle that the hawks are wanting to embark on. What history tells us is that you rarely see one hike. You usually get a sequence of hikes whenever you enter a rate hiking cycle. And therefore, it's kind of a good, I think, idea to kind of compare what we're at currently in the markets to what happened last time, maybe in early 2022 when we embarked on a rate hiking cycle, and just look at things in the economy and markets. So let's just start with like the labor market, for example. Back in early 2022, the U.S. economy was averaging around $400,000 or 400,000 jobs per month. If you look at JOLTS, the job openings, which I consider a good proxy for labor demand, that was standing around 12 million jobs. So 12 million postings in early 2022. You look at wage employment costs, those were growing roughly around 5% year over year. You look at the Treasury market, the 3-month Treasury yield was around 44 basis points. The 10-year was at 2.19, and the 30-year was barely higher, around like 2.5%, let's say. So that term premium across the curve was pretty flat, from 10 to 30, and it was relatively minimal there from the 3-month to the 10-year. Today, I think you've seen, such a large repricing starting with the Treasury markets. You look at the 3 months, it's at 3.89%. Term premiums around 100 basis points from the 2-year to the 10-year, which I think is pretty healthy given the fact where we're at. The job market, of course, is averaging, you could say, flat to even slightly negative job growth, depending on how much you want to, attribute those to relatively strong months. But we've seen those been revised down in the last labor market, and job openings have been almost slashed in half from 12 million. So my point is that these types of things that inherently would give you a wage price spiral, the thing that we would typically attribute to the Fed's major concern for embarking on a rate hiking cycle, just do not appear to be imminent, in my opinion. I think this is a very, very different economy from early 2022. And, I think the bar to hike rates, therefore, needs to be a little bit higher than what it is right now, just given how different everything is in this economy, and how weak the labor market is, and how high Treasury yields are already trading. If you just want to compare that, we've seen a lot of financial tightening compared to where we were when we had that great inflation coming out of COVID.
Yeah, I also, I think, Mark, you mentioned this before, which I think is a really interesting question. Is what does a Fed rate hike kind of solve in the wake of like responding to a war-driven increase or supply shock to oil prices? What would be the goal of the rate hike in order to try to drive inflation down? I mean, the only redirect I would be trying to do some kind of demand destruction or weakening of the labor market to further pressure down prices in other areas of the economy. And I just think that's a bad trade. I think it's politically a bad trade, and I think from the central bank's perspective, I know that Kevin Warsh keeps saying that he doesn't view interest rates inflation and labor as a zero-sum game. But I do think that I don't know how you achieve the outcome of lowering inflation through rate cuts without instilling some kind of demand destruction in what is otherwise a zero-sum game.
Yeah, and we're in a pretty tight labor market. So I mean, just looking at the participation rate, that's dropped off, which has kind of kept unemployment pretty low. I mean, if you start destroying demand and you start to see the labor market turn around as a result, it probably turns pretty quick, and they have to know this. And I don't think they want you coming into, they don't want to see you printing 5, 6, 7% unemployment at any point. That's not going to do anybody any good, because oil prices, will still stay up, even as a result of the war. So now you have people with higher costs and less jobs. So it's kind of a, you put yourself in almost a stagflationary environment if you do that.
Which I would argue we kind of might already be in stagflation. I know that the Q3 real GDP figure is pretty high right now, but that has followed the same sequence. If you look at Q1, Q2, every time you've looked at like the GDP now or the higher frequency measures for forecasting GDP, they always kind of start out relatively high, and we've seen them drift down in the past few quarters. So I kind of take that with a grain of salt. But if you look at the composition of nominal GDP, nominal meaning inflation plus real, it really has shifted from a pie that was more evenly distributed between real and inflation to now nominal's been mostly driven by pricing pressures, and very little real GDP growth is happening, as we saw in the last quarter print. So I think stagflation is really kind of, you could say it's already been called. It's here, and that's how we kind of define it, is just looking at that shift in composition between nominal GDP. So I think one last question with the Fed, and then we want to jump over to the next topics, is that, we will have another X space to talk about this, but later on this month, we do have the Jackson Hole Symposium. And if you've been following, the Fed for the past few years, it's always a time for the Fed to kind of reset and kind of set the agenda or set priorities on how they're going to conduct monetary policy. With a new Fed chair, Kevin Warsh, coming in recently, we should anticipate that there should be some pretty big announcements. The banner for the symposium this year is Financial Innovation, Implications for Payments and Policy. He also, Chair Warsh, has also 5 task force currently rewriting and reviewing the Fed's operations that stem from communications to balance sheet policy, data, and studying productivity and jobs, along with the overall inflation framework. So I wanted to ask Tomas first, what are you expecting from the Jackson Hole Symposium? What kind of messaging are you expecting from this new chair?
To be honest, I'm mixed on it, because I feel like, to be fair to him, he set up these task forces, and I think he staffed them around July timeframe. So those people haven't really had the time to really dig in and produce anything of meaningful, I think, substance. And he had signaled that his expectation was that their recommendations would come sometime later. I believe he used the term fall specifically. So I had it in my head anyway that the impact from these recommendations, you wouldn't even get the recommendations until like sometime October or November probably, and then the action from there would be at the earliest, I would suppose, December. He has made the comment that around like PCE index specifically in the last meeting, that's what the Fed has committed to as of January, and that's something that is part of their annual communication process. They might look to revise or change and whatnot, kind of like create an uncertainty around that, I think, in general. And so my guess is that he doesn't have anything of substance to talk about in the task forces, and he has this clear preference for not providing forward guidance. I think he's going to do a little bit better than the July FOMC meeting, which I think disappointed a lot of people because there wasn't any kind of real rigor in his discussion points, probably because more than half the questions were on forward guidance. So my suspicion is that if he wants to move the talking points to something more interesting, it would be perhaps a reflection on recent trends and the ones that he finds most interesting or meaningful. So that could be acknowledging things like the recent labor market weakness. And I think that's kind of the read-through that I'm most curious about, is what are the parts of the economy that he seems to take the greatest amount of interest in. And I think that's going to be the read-through that I care about most.
Mark, what about you?
Yeah, my view is kind of, I'm kind of mixed on this. I don't know exactly what we're going to see here because I remember Powell would use this as a pretty good time to give a lot of forward guidance. Here, I don't really expect that. I guess I'm kind of we'll wait and see what Warsh wants to do, and this will definitely set the tone kind of going forward for what we can expect out of him in the Fed. So,
I think one thing out of left field perhaps that might be of interest would be some of the discussion topics that Scott Bessent has volunteered around, particularly the yen intervention and the facilities that he's calling for, and sort of trying to understand the working relationship between the Fed and the Treasury. Like that would be another topic that isn't technically forward guidance that I would be very interested in.
Yeah, it's going to be, I think, probably one of the more eventful Jackson holes in some time. I think the last Jackson hole that really stood out to me was, I think, in 24. So 2 years ago, we had we had the signal that we were going to kind of embark on that rate cutting cycle, and of course, we only had a few rate cuts that ultimately materialized, but it was pretty significant in moving the markets back then. So it's gonna be interesting to see how this goes. We got a few more weeks, and we'll talk about it maybe again next week. But I think there's just a lot going on, and a lot with the out of DC in particular with the Clarity Act. We've seen that the Senate leadership filed a motion to proceed to put it up for a vote as soon as September 15th. Cloture requires 60 votes. It's tough to tell where the Democrats stand. Of course, ethics has been a major thorn in this bill's side, preventing, I think, more of the constructive news to kind of permeate through on the reporting side. So we're still, I think, a bit in limbo whether or not this gets passed, which is why we'll ask Mark here first, since he's down near Foggy Bottom in Virginia. How would you define this September vote precisely? Is this about actually trying to get the bill approved? Do you see this as a vote on debate? Are we just trying to see where the senators stand before the midterms? What's your read on this?
I am starting to think it's pretty 50-50 on what's going to happen. So look at the composition of the Senate. We have 53 Republicans in there. Assuming they all vote yes, which they may or may not, we need anywhere from 7 to probably as many as 10 Democrats to come over the aisle and move. And if you just look at some of the stuff they've been posting on X in recent weeks, then there have been senators such as the senator from Maryland who's a Democrat. She's kind of flip-flop back and forth. So there is still, in my view, some room for negotiation over this month. They'll talk while they're in recess. Then maybe we'll get something out of it. But yeah, I think the primary goal here is to try to get a vote on the record before, because the problem you have from a procedural standpoint after you have this vote is it's already September 15th. So say we were to get the best case possible outcome and it were to pass, a couple of things can happen. It can go back to the House and they can approve all changes with nothing of their own and then send it right over to the president's desk. That could easily get done before things turn to midterms starting in October. If you get the House, their committees wanting to make some changes to the bill, and then it goes back to the Senate, you're unlikely to have enough time to get the bill fully negotiated back and forth before October when things start to move towards midterms. Now, the good news for us in particular is that if you look at where the market's kind of pricing this on Polymarket or Kalshi, we're looking at the odds have really dropped off significantly, 20-30% of passage in 2026. So there's significant upside here if this passes, and there's really not much downside if this doesn't go through. You price out 20% to zero. It was as low as 10% last week, so the market's largely priced this out.
Yeah, I do think that it's really tough to know, I think, what's really going to happen in this case. And I'm by no means a political analyst, so I'm I feel like I've definitely been drinking from a fire hose, trying to understand everything that's going on with how far we've come and where we are right now. It does seem like we're now getting to the point to where the vote's going to happen. Whether or not this is just kind of like last minute political signaling to get people on the record or not, I think we could be in for a surprise maybe if some Democrats do end up deciding to jump on board with it and get it across the finish line. Tomas, what's your view? Do you think this bill is correctly being priced in right now with being close to dead, pretty much?
No, I'm definitely more optimistic. Like I think Mark put it best. It feels more coin flip to me, and with the odds at like closer, I think 20-25% now. I think the market is underpricing the ability to get a compromise done and get it through. But I think it probably does reflect the complexity of the procedure here and sort of the 11th hour that we're striking it, which just makes at least things more room for like politics or games to like play a role, and then technically delay it into a new Congress, at which point you have to relitigate a lot of stuff. But I think if you think about like the fundamentals of it, and the complaints in particular, so things like ethics, for example, if you don't get a compromise on ethics, then we're left with a market or an opening where there is no ethical requirements from U.S. government employees, and including the administration. And so, are we in a better place or not? My personal view is that we're not. Same goes with consumer protection. Same goes with any kind of anti-money laundering provisions or provisions around DeFi. What I think the crypto market is benefiting from more recently is that we've had a lot of open discussion from the regulatory bodies, particularly the CFTC and the SEC, where they've stated that they are ready to proceed on rulemaking if Clarity Act doesn't pass. And so that is not the best solution, in my opinion. Like, you always want legislation because it's permanent, but rulemaking is not a joke, right? It's not something you can just strip away. And those processes also take time, generally more than a year. And so my view on this is that the crypto market is getting some relief, that the regulators have signaled that they will move to rulemaking if legislation isn't passed. So it's not all, buried and dead. But I do think that right now, a lot of the issues that confound this bill are almost purely political at this point. And I think the lack of a bill is a worse situation fundamentally, even on those political matters. So that's why I have more of an optimistic take that I think this does get negotiated at the 11th hour and get done. And you guys mentioned, very importantly, the conversations are happening. So this isn't a deadlock where they're not even talking to each other. And I think that's really important.
I think we have a guest arriving here. Ish, are you able to do a sound check?
Testing.
Awesome. Sounds great.
You guys hear me?
Yes, loud and clear. This is, I think, maybe your third or fourth appearance or something like that. So no need to do the introduction, but welcome to the show. We have Ish from Bitwise, Research Analyst. I don't know if you want to give us any takes on Clarity. We were just kind of discussing whether or not this is kind of more like just a political facade of trying to get people on the record, or is there something material here that we're going to perhaps get some compromise, like what Tomas was saying, and perhaps markets are underpricing the odds that we get this done this year?
Yeah, no, thanks for having me on, as always. I largely agree with what you guys have been saying. I think, like Mark said, there isn't much downside anymore to this not getting through, in 2026, whether it's September or beyond. And also, like Tomas said, I'm kind of banking on the SEC stepping in here. As Atkins said a couple of weeks ago, they're ready, willing, and able to implement the rule changes that would address the issues Clarity was going to. And yeah, I mean, obviously it's not a perfect solution, but I think should that happen, that will kind of let the genie out of the bottle for the industry, to the extent which, even though it's not a permanent solution, it'll stick around enough and allow the crypto industry to flourish to the point where when we are ready to pass some actual legislation, like the industry will be in a good place by then.
Love it. So I think that's a good, strong ending to that segment. And we can kind of start to close out the show where we're going to talk a little bit about DeFi valuations, DeFi fundamentals. We've seen a lot of changes here, and I think a lot of narratives start to build within some stories here with some protocols. They're starting to become more like cash flow stories. We've done our fair share of research here at CF Benchmarks. We did a Hyperliquid hype valuation framework on how to break that down and compared it over across to some traditional finance names. Ish, I know that you and the Bitwise team have been diving deep in the research. Is it the research layer, or how do you say it? Is
The research layer
it-
is our little room here in the New York office.
Okay, and this is the layer where we bring. I'm imagining all the best and brightest ideas on discovering alpha. So I was hoping maybe we could start off with you. What are some of the protocols that you all have been kind of breaking down recently? What's kind of been the thesis, or what are you seeing when it comes to some of these DeFi names?
Yeah, I think some of the protocols we've been looking at. Firstly, we're kind of leaning into this revenue generating era. Obviously led by Hyperliquid, who's kind of paved way for that. Not just generating revenue, but recycling that into the protocol and buying back tokens somehow. That way there's like direct value accrual. And along those lines, we're also looking at Aave and Uniswap. These are some that I think are doing promising buybacks. Also, Pump.fun is a big one. People like to discount that because it's a meme coin platform, but in terms of revenue, it's up there and like I think maybe top 3, top 5 protocols. But I really like Aave because it's biggest DeFi protocol for lending and borrowing. Generates a lot of revenue. They have their stablecoin GHO, which is a very high margin for them. I think as we see more assets come on chain, one thing I've been pitching is DeFi decade. I think stablecoins, tokenized stocks, as all these things come on chain, they're going to seek places to be productive in DeFi, like Aave or Uniswap. You're going to see volumes increase. That's going to generate more revenue. The protocols are going to buy back their tokens more, and I think there's a lot of investment opportunity there.
Yeah, that's a good point. I saw a tweet that you posted yesterday. It was actually a retweet from Yano from Blockworks on Uniswap RWA volume. And you can see, one, it's a hockey stick just shooting straight up right now, but it's really a story of tokenized equities that's driving this narrative. And we, of course, work closely with our sister company, X Stocks. And we had Val Gui on a few weeks back. How big of a story is the equities component for DeFi? When you look at the RWA momentum that we're seeing.
Yeah, I think it's going to be huge. I see X Stocks on here. Shout out them, pioneering the space. Definitely, I think it's going to be maybe a 10x in tokenized stocks on chain over the next few years. Right now, we're maybe 30 billion in tokenized assets. I know stocks is a small portion of that. I think tokenized assets, including stocks, are going to 10x to maybe a couple 100 billion. And that's going to, obviously, there's going to be lots of volume through dexes like Uniswap. Perps is one thing that's happening already on like Hyperliquid, but I'm more interested in like the tokenized actual like spot stocks and the wrappers. And I also think that's going to be a huge opportunity for lending and borrowing. Like permissionless lending against like tokenized Apple is something that can be unlocked on a protocol like Aave for any individual user.
Yeah, another thing that I think is going to be pretty big with the tokenized stocks too is the ability to use them as collateral now for your perp portfolios and your positions there. So if you're on Hyperliquid and you've got SpyX in your portfolio, you could now, if you wanted to take advantage of the perp basis, if that gets high, you could sell SPY perps against your SpyX holdings, and you could arb that basis down. So it really opens up a whole bunch of new strategies, as well as better ways to get leverage, because now you don't have to sit and hold stable coins or other crypto or might be more volatile collateral on there.
It's really a story to me, like, of how we're opening up the accessibility of financial utilization. If you think about how traditional markets work, asset-based lending is something that is very popular if you have a pretty significant liquid net worth, you have a lot of assets. But when you look at the way these protocols are algorithmically, a rules-based framework for giving people either optionality of utilizing the liquidity, like what you were just highlighting, Mark, it's something so powerful that I think a lot of people don't fully appreciate it yet. What could be possible? I mean, it's being built out right now, and I think that yeah, it's going to be fun to see. Right now we're seeing a booming in tokenized equities. Of course, it was tokenized treasuries or money market funds that initially started the RWA train, but I think it doesn't stop there. We're going to continue to see more and more types of assets come on chain. I think the time will come when you start to see more of the sophisticated type products being tokenized. So you think about structured products. You can think about private equity. You can think about private real estate coming on chain, or other private assets. These are things that historically have had a pretty high hurdle of access for society, and that's just about ready to get knocked down. I see it with this type of technology. Tomas, I wanted to bring you in on this discussion. Are there any sort of opportunities that you're seeing with this revenue generation story? We've seen how these names have really started to ramp up. Their fee switches, for example, to burn more tokens. It kind of goes back to basic economics, right?
Yeah, I mean, I have a bit of a longer term take on this. So I don't know if it was late last year or the year before, but shortly after the election, like, I had a pretty straightforward thesis, which is for several years in the DeFi space, really around 2021, 22, I believe, a lot of these tokens that were minted, particularly out of DeFi summer, by design, their design was in large part dictated by the regulatory environment back then. So the concept of a governance token, one that gives you no benefits outside of just voting on proposals, was the champion of DeFi tokens. And it was in large part because you had several tokens that had this kind of like buyback or burn mechanisms that were being punished by regulators as potentially problematic, but without any guidance as to what part of it was problematic and how, etc. And I think with the end of the Gensler area, my thesis was straightforward. You're now seeing a return of interest into these kind of buyback fee return mechanisms that drive actual value accrual beyond governance. And it's kind of a snowball effect, because once you see one protocol do it and you see the attention it gets, then all the other protocols start to really think about, hey, maybe I need to make the adjustment for my governance token as well. The problem is, and this is where I speak to my own personal book, is that if you invested on this thesis, a year ago, you've still been crushed, right? Like, DeFi tokens are still down considerably over the last year to date, etc. And of course, following the crypto market. And so I do think that this thesis is real. I actually think it's a better outcome longer term, but in the immediate term, in the near term, the people who've been leaning into it have felt punished for it. And so in that respect, I actually think that the upside potential might be even more interesting, because people are a bit hesitant to lean into it because of the performance year to date. So I am really bullish on it. I think the interesting thing about the hype story isn't so much that they, trailblazed the path here, because I don't think they did. The big difference there is that they were able to monetize volatility outside of crypto through oil markets, equity markets, etc., and reinvigorate this kind of interest in those mechanisms and value accrual drivers. And so tokens like Pump, Aave, Uniswap, to the extent that they have that moment in the sun again, like they did in the past, and they continue to grow, I think hype kind of shows what the potential value of growth can look like.
Yeah, another thing, one thing that I've also been kind of interested in watching as a result of all of this is like the change in the makeup of total value accrual. I've seen some charts out there that were saying layer ones used to be 80-90% of the fees. even just a couple of years ago. I mean, now that's less than 50% with these protocols really coming in and taking most of the fees. So, jumping back to some of our earlier points on ETH, why they might want to try to get that burn rate down and pursue that sound money or monetary narrative, it's that I don't know how much value is actually going to accrue to these layer ones outside of Hyperliquid on a go-forward basis from all the revenue that's generated.
Yeah, I totally agree. I think when you look at a lot of the coins out there, they are just sitting on like huge monetizable opportunities. And like Tomas said, I think, because of how far they've been beat down, it's extra upside. So like on DeFi, that makes me think of Morpho, which has, rapidly growing TVL, institutional adoption, but the token, I think, is just for governance. It doesn't have this value accrual or like fee switch turned on. But should it do that, there could be a huge pump. And then same thing with ETH. It's the platform with the most stable coins, and some of the most tokenized stocks might be second behind Binance Chain lately. But huge monetizable opportunity. Should they figure out any tokenomics improvements, that's a lot of upside.
Yeah, and I think that's a really strong point. If you look at I think the major headwind that Hype kind of faces is that employee unlock schedule that we've seen impact price at times. It's still kind of one of those things where I wrestle with because of the fact that it doesn't force the employees to sell their Hype, right? It just unlocks it. Despite the fact that we continue to see the protocol continue to buy back or burn tokens through its volume and fee generation. However, those volumes have kind of come down. Ish, what do you make of like the recent kind of dip in Hype volumes that you're seeing now?
I think it reflects the perp market broadening out a little bit. I know Lighter has been doing some big numbers, bringing perps to Ethereum. You have other protocols like EdgeX. And then it's also just reflective of like a slowdown in crypto sentiment. I think perp volumes in Hyperliquid peaked probably around last October when Bitcoin was at all-time highs. But I think it's something that will return because perps are kind of a superior product. It's a lot more flexible for traders. They can short, they can use leverage compared to something like spot.
Perfect. No, I think this was a really great conversation, and we have just a couple minutes here to do the final round, which is the week ahead. So we're recording this on August 13th. This is for the next 7 days, or even further if you want to go out. I know that we've got some other things on the horizon with the Jackson Hole Symposium, but let's do a fast round and go around the horn and share what or what's top of mind. I'm going to pass it to Mark first and get his take, and then we can close this out.
Yeah, so first up for me, I'm going to be watching is the activity coming out of MicroStrategy now that Stretch is pretty close to back to par. See what they do if they choose to raise capital, try to buy Bitcoin or anything in between, really. The next thing I'm going to be kind of on the lookout for is any headlines or further progress on Clarity. Just that ethics provision is still sitting with the White House, the Democrat version, so we'll see if there's any movement there. And then I believe we've got a little bit of Fed speak coming up ahead of Jackson Hole, so we'll kind of see what they're saying over there.
Perfect. Tomas, and then we'll let Ish go last.
Yeah, I think for me, I would say any kind of press, although I suspect that we're too early for it, any kind of press on Clarity Act negotiations. I think everyone's just taking a break, so this next week might not be the one for it. But I agree that Jackson Hole is going to be a big part of the conversation. And then I also want to see, I think, just ETF flow's reaction to this latest shift in rate hike odds. As well as any news outside of this U.S.-Iran conflict on a potential negotiated agreement between Oman and Iran on the traffic way, because that's been on standstill for a week now.
That's definitely something to follow. Ish, what's top of mind for you?
Yeah, for me, it's definitely going to be ETF flows as well. In the past month or so, they've flipped positive after being pretty overwhelmingly negative since about May through mid-July, particularly for Bitcoin and Ethereum. But recently we saw those two start seeing some more inflows. And interestingly, some of the altcoins have also been holding up, like Solana, Hyperliquid, of course, Chainlink, XRP. They've been seeing inflows. But for the two majors, Bitcoin and Ethereum, I'll be paying attention.
Yeah, I don't think I have too much else to add. You all had covered it really well with the week ahead. I think today, though, we were going to have a 30-year Treasury auction. About 25 billion is going to come onto the market. Craig Shapiro, our good friend over at Ninja Trader, flagged this earlier this morning. And I thought it was a great take, so I'm just going to echo that. It's going to be interesting to see how this additional supply that's helping finance what is a ballooning deficit each month. It keeps, I think, surprising up to the upside. We just saw how the June deficit was completely above estimate. Of course, let's keep an eye on the flows, on ETF flows. They're trending positively. Let's keep an eye out on I think tomorrow we're going to get the SEC open meeting on regulating crypto, which should be interesting. And the last one, that what Tomas was saying about the geopolitical risk, it seems like it's going to be happening every week. If you missed this discussion, don't worry, we have it recorded. We'll be publishing it on all major podcast platforms, Spotify, Apple Podcasts, whichever one you prefer. And it was a lot of fun having you jump in later on. Ish, it was a great surprise. Thanks for joining. As always, do your own research and trade safe, and we'll see you all next week. Thank you.